I was having breakfast the other day with another YouTuber that you probably know. He was like, hey, you spent most of your career on Wall Street. How should I invest? I have been asked this question so many times, and every time I answer it, I just see the other person's face light up. Helping people is fundamentally why I quit my job on Wall Street and became a full-time YouTuber. So rather than give the same answer over and over again, today's video is my super concise guide on how to invest. Now, here in the USA, to give personalized investment advice, you have to be a financial advisor. It's basically a qualification that you do that is regulated by the government. The aim is, of course, to ensure that financial advisors are acting in the best interest of their clients. Now, even though I spent over a decade working with hundreds of financial advisors, and I did study for the Series 7, which is the exam that they take, I am not one. You see, in banks like mine, they don't want you holding a license unless you're actually in that specific role. Anyway, what I'm trying to say here is that this video is educational. It is not individual financial advice. During the course of this video, though, I will talk about when to engage with a financial advisor, because not everyone should. Step number 1. Ensure that you do not have any high interest rate debt. We're talking about credit cards, car loans, and that sort of thing. Pretty much any loan with an interest rate above 8%. If you do have them and you are struggling to pay them off, here are a couple of things that you can do. You can try to consolidate your debt into a lower interest rate loan. You can try to sell some material possessions or downsize to pay it down faster. You could try to learn a new skill set to raise your income. Or, and I hate to say it, take on a second job. Having your debt under control, it isn't just important from an immediate financial perspective, it's also going to be important in the future. It will make you look more creditworthy, which means it will be easier to get a loan with a good interest rate. Say you want to get a mortgage. Okay, so if you've cleared step number 1, step number 2 is to ensure you have short-term savings. You don't want to go back into debt for a medical issue, a major repair on your home, losing your job, and that sort of thing. Also, if you have investments, you do not want to be forced to sell them at a bad time to cover a short-term need. Say the market just drops all of a sudden, if you don't have enough savings, you may have to sell out. Additionally, even if the market drops, but you are still ahead of what you originally bought your investments for, that will likely trigger capital gains tax. So, selling out at an inopportune time kind of has a double whammy, where you're getting less from your investments and you're paying tax. Selling out of investments, it should be done strategically, not because you have a leak in your roof that needs to be fixed. Now, in terms of how much to keep in savings, I've often heard 3 months of expenses. I don't like this. 3 months is probably the minimum I'd recommend for a single person with a secure job. For most people, I'd suggest 6 months worth. If you do have dependents like kids, that should be at least 12 or ideally 24. In terms of where to put your savings, please do not store it in a low interest rate checking or savings account. Guys, your money will be going backwards. Over time, money devalues due to inflation, normally by around 3% per year. You want to keep your savings in an account that gives you at least that in interest. Look for a high-yield savings account or a money market fund. The difference between them is that a money market fund, it's really a security that must be bought and sold in the market, which only trades certain days and at certain times of the day. So, it can take longer to access your money than a high-yield savings account where you can pretty much access it at any time. I personally use Wealthfront's high-yield savings account. When choosing one, just make sure it is insured. In the USA, this is called FDIC insurance. It means your money is insured by the US government, up to $250,000 per depositor. I won't get into the weeds of this too much right now, but good high-yield savings accounts, they actually use real banks behind the scenes, just with negotiated higher rates than what you would get as a consumer. Being a bank in the USA, it's a protected term. It means that it is regulated by the US government to ensure it's stable and can be relied upon. Because of that, the cash you hold in a bank is insured. Last note on this step. Obviously, don't put all your money in your savings account. Make sure you keep enough cash on hand to cover upcoming bills. Even those high-yield savings accounts, they can take 24 to 48 hours to get the cash out. The last thing you want is overdraft fees. Alright, if you've got your debt and savings in order, it's time for step number 3, investing. The first thing that you need to know when investing is what you don't know. Large companies are incredibly complex. Whether they're a good or bad investment, it depends on so many factors. Just hearing about an exciting new product or having a gut feel, it does not mean that the company's shares are undervalued and you should buy in. When I was at Morgan Stanley, I actually got to meet some of the teams who predict what a company is worth and whether its share price is overweight or underweight. These teams track each of the major business lines that the company has. They forecast demand for their products, they look at what competitors are doing, they look at the changing cost of supplies, they even factor in macroeconomic things like tariffs and interest rates. Investment banks do this because they want to give their clients an edge. I'm giving you this example because I want to highlight that most individual investors, they simply do not know enough about a company and its valuation to know whether it is a good buy or not. And by the way, this also applies to people doing day trading who are looking at patterns and sudden changes in prices. Quantitative hedge funds, they are doing that analysis much faster than you can. Also, you need to keep in mind trading isn't free. Even if you are promised free trades on a brokerage account, when you invest, you'll notice that the price you can buy a stock at is higher than what you can sell it for. That difference, it's called the spread. It's the amount that the companies who create the markets get for their services. You can think of it similar to real estate, where the brokers get a fee for facilitating a sale of a house. Moral of the story, investing isn't free and you shouldn't take risks that you don't truly understand. So, here's what most people should do. Open up a brokerage account at an established company like E-Trade. In full transparency, E-Trade, it is owned by Morgan Stanley, where I used to work. Once done, buy a low-cost equity mutual fund or ETF that tracks the broader market like Vanguard's 1VOO. In the USA, the broader market, it's known as the S&P 500. It is essentially the top 500 companies. If they go up in the aggregate, you go up. This gives you the exposure to the stock market without the risk that holding an individual stock has. In general, when investing, the amount that you can make, it depends on how risky your investment is. Higher risk investments like crypto, they do have higher rewards, at least they can, but they have huge risks associated with them. What I proposed here of buying a low-cost S&P 500 ETF, it is a good balance. And FYI, I'm not the only one to say this. Warren Buffett also gives this recommendation for most individual investors. Now, on the topic of risk versus reward, what I've described in this step, it's really for those in wealth accumulation mode, i.e., you plan to keep your money invested for several years. That way, you can recover from sudden stock market drops. Those certainly happen. If you are close to retirement though, this isn't the best strategy. You'll likely want to reduce your risk with something less volatile and just accept a lower return. Generally speaking, as you get closer to a point at which you want to withdraw your money, you want to rebalance your portfolio with less risky assets like AAA rated bonds. This actually leads very nicely to step number 4, which is to diversify. Once you hit around 100,000 to 200,000 in stocks, you'll want to start putting money in other investments. That way, you just don't have all your eggs in one basket, obviously. There are many ways that you can do this. You can invest in real estate, you can invest overseas, you can invest in bonds, like I said. Personally, I chose property as my first real diversification. Now, there are a ton of videos out there from influencers saying that you should not buy property, that it's a bad investment. Its returns suck compared to the stock market. Property has maintenance costs that people often overlook. Homeowners association fees, you guys get the point. Look, on the surface, these influencers, they aren't wrong, but they're also missing something very fundamental. Economics goes through cycles. Right now, interest rates are high. Few people can afford to buy homes, so demand is low. That drives down the property prices and makes returns on properties look terrible. In the pandemic, though, things were the opposite. Interest rates were at historic lows. Property was in huge demand and people were making a ton of money on it. So please be aware of influencers who give advice that is really riding a market high and just not factoring in broader economic principles. The basics of investing is buy low if you can and sell high. Right now, the stock market is high and property is low. Now, this doesn't mean to not follow the steps that I've laid out in this guide. It's still fine to buy into the market if you don't need that money for a long time. You'll weather sudden drops and over the long term make money. Getting disciplined about investing is always a good thing. I just wouldn't rule out property as a good investment. I mean, come on. If property was so bad, no one would buy it. Anyway, be careful of who you take financial guidance from. That is why financial advisors exist, and if you're unsure of how to diversify or what you want to diversify in, then wait for step 6, where I discuss who should engage with an advisor. Alright, so if you've done my 4 steps so far, you're ready for step number 5, which is to have a little fun with investing and to speculate. This is where you put a small portion of your total investments aside to buy something that is risky that you just want to try. Maybe it's that stock that you have a hunch that will do well, maybe it's day trading, maybe it's cryptocurrency. just don't put more than 5% of your total assets in it. You want to make sure that you do have your finances secure and well in order before doing this. The number one issue that I see with individual investors is people just skipping to this step and putting their money in risky assets so that they can get rich quick. It doesn't work like this. Most people just lose their money. If you look at wealthy people, the majority of them, they do have discipline, they've followed the steps that I've outlined today. Alright, step number 6, the final step. Seek personalized advice from a financial advisor. An advisor can tailor a plan to your specific investment goals. They can help suggest ways to diversify. They can set up portfolio rebalancing to reduce your risk as you get close to achieving a goal. They can even help you with tax optimization strategies, which can be a really big thing for wealthy people. In fact, if you're wealthy enough, working with an advisor can just unlock a bunch of things that I believe are one of the reasons the rich keep getting richer. For example, they can give you access to invest in a hot new company that's listing on the stock exchange. You can buy at that company's IPO price rather than wait till it's gone up in the secondary markets. They can also help you get a securities-based loan. This allows you to leave your money invested where it is growing fast and instead just borrow to pay for things you may need liquidity for. A home renovation, for example. This is really arbitrage. You're essentially leaving your money in the market where you're getting a higher rate and instead borrowing at a much lower rate. Let's say the market returns 8 to 9% and your loan is 5%. That's a nice 3 to 4% difference. You're able to get that low rate because the loan is securitized, meaning your stock is the collateral if something happens. The banks can just claim it. It's not like a credit card where there is no collateral and so the banks need to charge a higher interest rate in case people default. Also, if you use one of these securities-based loans, you avoid paying capital gains tax, as you aren't selling your investments to get cash. Now, these do have risks. If the market suddenly drops, you can be forced to sell out, also known as a margin call, and you could just lose everything. So, generally speaking, don't take out one of these loans for more than a very small portion of what you have, which is why you should be getting these through a financial advisor. That way they can guide you. Financial advisors, they're really like any service business. The more you pay them, the better an advisor you get, and the more time you get with them. The way most advisors charge, at least the ones that I know, is based on a small percentage of your total assets that they manage. This tends to be stocks and does not include your equity in your house. This compensation method, it incentivizes advisors to make you more money. But it also means if you don't have much money to begin with, they don't make much and it's probably not worth getting one. As a general rule of thumb, if you have $250,000 to $500,000 in total investable assets, you probably should start considering one. Once you hit $1 million, that's kind of the sweet spot to get a good one who's going to give you proper time. Alright, I think I've covered a lot of ground here. As I wrap, don't do stupid stuff. Please don't just jump and try to skip steps like most people do. And don't listen to the gloaters, people who are very quick to talk about their huge unrealized gains in something like cryptocurrency. But when the market drops, they're eerily quiet. If there is another topic that I can help you with, just leave a comment below. I love making these business and career videos. Get subscribed with the notification bell on because a lot more are coming and you won't want to miss them. Till next time, go do something awesome with your day, and I will catch you later.